Hey everyone, welcome back to the channel. Today we're diving into an important topic for anyone looking to build wealth: long-term versus short-term investment strategies. Whether you're a seasoned investor or just starting out, understanding these two approaches can make a huge difference in your financial journey. So let's break it down. First, let's talk about long-term investments. These are investments that you plan to hold for years, even decades. Think of it as planting a tree. Over time, it grows stronger, more stable, and bears fruit. The key here is patience. Common examples: stocks, real estate mutual funds, retirement accounts. Long-term investing allows your assets to benefit from compound growth, where your returns start generating more returns. Historically, the stock market has averaged about 7 to 10% growth annually over the long haul. The main advantages of long-term investing are compound interest. Time in the market beats timing the market. Lower taxes. Long-term capital gains. Taxes are typically lower than short-term taxes. Less stress. You don't have to worry about daily market fluctuations. Plus, the longer you stay invested, the more likely you are to ride out market volatility and see overall growth. Now let's switch gears to short-term investments. These are designed for quick returns, usually within a year or less. It's like sprinting instead of running a marathon. You're looking for fast gains. Some examples include day trading stocks, cryptocurrency options, trading short-term bonds. Short-term investing requires a lot of attention, quick decision-making, and often a higher risk tolerance. But it can be incredibly rewarding if you know how to time the market or spot a good opportunity. Here are some reasons why people love short-term investments. Quick returns. You don't have to wait years to see results. Flexibility. You can easily liquidate assets if needed. Excitement. The thrill of chasing profits is real, especially for active traders. However, be cautious. Short-term strategies are risky, and you can lose money just as quickly as you make it. Now let's compare the risk. Short-term investments are inherently riskier due to market volatility. Prices can fluctuate drastically in a short period, meaning you could face big losses if you're not careful. On the other hand, long-term investments tend to be more stable because they give markets time to recover from downturns. That's why Warren Buffett famously said, "The stock market is a device for transferring money from the impatient to the patient." So which strategy should you choose? It depends on your goals, risk tolerance, and time horizon. If you're aiming for retirement savings, want steady growth, and can tolerate the ups and downs of the market, then long-term investing is probably your best bet. But if you're looking to capitalize on market trends, have some money you're willing to risk, and enjoy an active approach, then short-term investing might be more your style. You don't have to choose one or the other. Many successful investors use a combination of both strategies to balance risk and reward. At the end of the day, investing is all about finding what works best for you. Whether you're in it for the long haul or prefer short bursts of activity, the key is to stay informed, manage your risk, and stick to your strategy. Thanks for watching. If you found this video helpful, give it a thumbs up, and don't forget to subscribe for more financial tips and insights. Let me know in the comments. Are you a long-term investor or do you prefer short-term strategies?